Hey everyone, welcome back to the channel, your number one source for income-oriented investing. I got the CEO of Harvest once again back on the channel, Michael Kovacs, a favorite returning guest. How are you, Michael?
I'm well. How are you?
I'm doing great. I'm doing great.
That's
Thanks so
good.
much for doing this again. Today's going to be, we'll freestyle a little bit. I want to ask you a little bit kind of a summary of 2024. Maybe we could talk about the
Mhm.
markets a little bit, the upcoming election, which as we're filming this is in like 6 days.
Hmm.
And also, we're going to go through some member questions as well, which
Okay.
I think you get some similar questions all the time. I know you guys get emails and questions all the time, and a lot of them are on the list. So it's going to be fun. So, first of all, um, 2024, in terms of stock market, what are your perspectives? Anything that stands out to you? Anything surprising? Anything disappointing, maybe? What would you say of the markets?
Well, I mean, we all know the S&P's had a fantastic year. Tech has had a great year again. I mean, we still have a few months to go, but the earnings have been coming out very strong. The U.S. economy has been resilient. I think we all expected this time a year ago that we'd see the U.S. economy slowing down. We'd see interest rates drop off a lot more than they have, though they have in Canada, but not necessarily in the U.S. And that didn't occur. The U.S. market has continued to be strong. Earnings are coming out at great rates. Um, we're seeing travel continue and record bookings of hotels and
Yeah.
uh, people buying software and going to restaurants. And the U.S. economy is strong. The unemployment numbers are low. We've got a big election coming up too, as you know, as you just said, in a week. So we've had a very robust year. And from that standpoint, it's been a nice surprise that way. But we'll have to see how that bleeds into the end of the year and into 2025 after these elections are behind us.
Yeah, markets at all-time highs, right? The,
Hmm.
the the recession or whatever that everyone's been talking about has not come at all on the opposite. So I'm just curious what you think of. I heard the other day that there's still a record number of people in cash, money market funds,
Hmm.
waiting to get in. I feel really, really bad for those people. This is why
Hmm.
I'm a big proponent of not holding on to cash ever. That's just my personal opinion. What do you think about that? It's almost like timing the market, trying to predict the market. I'm someone who firmly does not believe in that. What's your
Hmm.
personal opinion on that?
Well, you're right. I mean, that was what we thought we'd see as well, more of that cash coming into the market as they continue to move up. There has been some, but not at the levels. I mean, there's still, I think, $6 or $7 trillion. I can't remember what the number is. That's still sitting in cash levels, record cash levels. But you also, even though rates have ticked down a bit in Canada, and we saw the U.S. Fed funds rate drop off, obviously last month, but rates are still relatively attractive on the short term. So if you can get 3.5%, 4% for sitting in cash as your risk-free rate of return, there's a number of individuals that have decided to do that. And some of these individuals have quite a bit of money, like are billionaires, and they're sitting in cash. So they'd rather wait until they feel much more comfortable with things. But to your point, and I agree with you, as you know, I've always been a proponent of the Warren Buffett way. You know, we've had Jeremy Siegel on here. We'll have him on again about stocks for the long run. I've always been fully invested as an individual my whole career. I continue to be. You can't time markets. And look at what happened this year, as we were just talking about. We've had a record breaking year for the S&P. We've seen the Magnificent Seven continue to be magnificent.
Yeah.
Earnings are coming in at a good pace. If you're sitting out, you've missed that. And if you look at the long-term historical rates of return, they're always around 8.5%. Some years you get 15, some years you get 4. But at the end of the day, just stay invested and let the market work for you. And we say it over and over again, but still people manage to want to sit in cash and feel more comfortable, or they switch back and forth. And there's been a number of studies done on investors that actually try to time the market, and they actually end up doing worse for themselves. And I'm one of those people. I've made mistakes. The biggest mistakes I've made as an investor is getting out too early and watching a stock double and triple and quadruple, as opposed to sort of selling something at a loss. So you just have to stay with the market, and if you're comfortable, stay with those investments.
Yeah, it's a common mistake people do, especially, newer investors, and I've made those mistakes before. And it's such common knowledge, you hear about it all the time, but it's so funny that people still don't listen to it. I find it very odd, but I guess just that's just the name of the game. So, with
Well, if
with
you're
the election,
trying
sorry,
to,
go ahead.
so if you're trying to build wealth, look at what the wealthy do. The wealthy do not trade. I say it jokingly, but Jeff Bezos doesn't trade Amazon. He holds it forever.
Yeah.
Uh, Tesla, same thing with Elon Musk. None of these guys are trading GameStop or trying to time markets. They're building something and they're staying invested. So Buffett's been a real life example over the last 6 or 7 decades of just staying invested and letting capital markets grow over time. And if you make the right decisions on the right companies, you will do well over time.
Yeah, that's a good point. That's a good point. Yeah, for sure. I agree with you. I'm long, long, long the market all the time, the
Right.
overall market. And it's even the Canadian market's been hitting record highs too. It's not just
Mhm.
the American market, but the Canadian market has historically always underperformed the American market. It's still the case today. I'm curious about the election though. I hear that, it's because of the election, people are waiting. They think maybe there's going to be some volatility. I love volatility. I know you guys do too because you have lots of covered call writing
Right.
programs, which increases premiums when there's volatility. So I'm just curious, your opinion. What do you think is going to happen to the market if Kamala wins? And what do you think is going to happen to the market if Trump wins? I know it's just a friendly prediction, if you will, and then I'll give you my opinion.
I think whoever gets in, whoever wins, the markets will make their shorter term adjustments. Maybe some more value areas will move, maybe some more growthy areas will move. But at the end of the day, markets will sort of just continue to trudge along like they have historically. Historically, if you look back, presidential elections sometimes have shorter term vibrations in the market, but they don't really influence the long term trend.
Hmm.
And if that's
Yeah.
what we're talking about, the long-term trend, yes, you're right. Volatility does help from the standpoint of writing calls and generating income, but the long-term trend won't change regardless of who gets into power. And both of these candidates, and we'll see what happens next week, both of these candidates are talking about very inflationary things. And I think this is also one of the reasons why you haven't seen the US rates back off the way we've seen literally everywhere else in the world.
Yeah, including Canada, right? They're cutting much more
Yeah.
aggressively than the US. And there's some questions around that, around TLT and Happy
Hmm.
T.
Yes.
We're going to talk about that. It's probably one of the questions you get. Just for fun, my prediction is if Trump wins, I think it's going to be, and I agree with you. I think whoever wins, the market will still go up over time, right? But I
Hmm.
think the market's going to react more positively if Trump wins. However, I do feel that if Trump wins, the oil prices are probably, the energy sector is probably going to be impacted in the next four
Mhm.
years because he wants to drill, baby, drill,
That's right.
right? So I think that could bring oil prices down. So of course it's good at the pump, but not necessarily for energy stocks. That's the only
Hmm.
kind of thing I could think of. But I think in general, either way,
But you're right,
business.
Adrian. This is why I would say there'll be some short-term movements in various commodities or value or growth stocks, but at the end of the day, the trends will continue the way they have over the long term.
Yeah, yeah, for sure, for sure. I think so too. Okay, so in terms of, you guys are a big ETF company. I think you're at what, at 5 or 6 billion now that you manage. It's going up
Mhm.
every day. And you guys get a lot of emails. What would you say in 2024? What comes to mind as the top two, three concerns, worries that you get that retail investors send to your team? What comes to mind right off the bat, would you say?
Well, the two main things, one obviously HPYT, which you mentioned, we can talk about. Obviously, with the backup in U.S. interest rates, people are concerned about the performance of that fund, the performance of the long-term bond market, the sustainability of income, and so on. And also, just generally, I'd say the second thing is people want to know, are overall our distributions sustainable for any of our products? And that's an absolutely logical question to ask. I mean, because when you can have double-digit types of rates, that's always a concern. Are these sustainable? And as you
Yeah.
know, and I've talked about it, we always test and test and test before we bring out products. We look at different product or market scenarios to test the ability to maintain those yields. And we launched 15 years ago, and we've never missed a distribution. We continue our banks and buildings fund, which is a tiny little mutual fund, but it's has a 15-year distribution record through good and bad times, through COVID, through everything. It's never missed a distribution or been cut. So this is why we work hard to make sure that we've got sustainable distributions.
Yeah, it's the eternal concern. I know I'll
Mhm.
get for the rest of my life, I guess, or until
Right.
I do run this channel, distribution sustainability. And yeah, I mean, I always when I think harvest, the first thing that comes to my mind is the distribution reliability and consistency because we've discussed this a million times before. You've said, we're not trying to be the highest payer, we're trying to be the most reliable payer. So I always feel like if that's really your a number one concern, if you're an investor, an income investor, the harvest products are, definitely the proof is in the pudding, like you just said, right? So
Right. Right.
for sure. But I get that question all the time. So yeah, I mean, I want to ask you some questions that members have asked. These are paid members on the YouTube channel. And by the way, I'm talking to the audience here. If ever you're
Mhm.
interested, just click that little join button next to the subscribe button, so you'll have the ability to ask next in the next Q&A some fund manager some questions. So I'm just going to share my screen here, and we'll go through a few of the let's go through. So hopefully you could see these questions, right? Hopefully
Yes.
I hope I'm doing it right. So the first ones, and this was the most popular question by far. You see
Mhm.
23 thumbs up, you see another one with 8, you see another one with 2. They're all related to Happy Tea, which I
Right.
keep always messing up. I always, is it HPYT, HYPT? I mess it up so many times. But anyway, Happy Tea. Okay, I'm going to talk
Right.
about that. So Mike says, leverage Happy Tea, please. Any reasons not launching leverage bond ETF? So Happy Tea is one of them, but you also have HPYM, the medium term. Happy Tea is the long term.
Mhm.
We wanted Captain Adrian to push it. Okay. So let's start with that. I know you can't talk about future
Right.
products, but what would you tell Mike?
Well, first of all, we have had a lot of inquiries about that, and we are investigating it. Um, but I do want to bring up the point that, remember what you're investing in here. You're investing in the sort of the long US bonds. So they are US treasuries, they are backed by the US government, but when you're further out on the interest rate curve, you have a lot more volatility. So what we've just seen is right after the Fed rate cut, the employment numbers came in much stronger than expected in the United States. We saw a backup in rates. The 10-year, I think, was down to 3.58. As of this morning, it was 4.3. That is a 20% increase in 6 weeks in that rate. So this is why you've seen TLT and TLTW and HPYT and other long bonds all drop down 7, 8, 9% because you've had this big jack up in the rates. The offset is we're paying that income, which helps to soften that blow. But until we see those rates start to sort of taper off, that keeps the downward pressure on any sort of long bond portfolio. So I guess my point here is if people want a levered version, then you can expect in these times of volatility, not an 8% drop, but you could be 10, 12, 14% down. And then you're writing options at a lower level on the NAV. So you've got more headwinds to grow back up when rates start to come down. So there's all these things that play into it. The offset is you're going to probably have a yield of closer to 20% or more with that type of product. So it can be done. We are researching it. To your point earlier, Adrian, we want to try to be more conservative and make sure that these are our rates and these are products that we can bring to the market that are sustainable over the long term. I see someone asked about the 15 cents. Is it protected?
Perfect segue. Perfect
Yeah,
segue.
it is very protected in the sense that, as I mentioned earlier, we test everything we do before we bring it out. We wanted to make sure we could pay that $1.80 a year on that initial NAV. In various market scenarios, we have the ability to write up to 100%, which ties into the next question.
Yeah.
We haven't. We've written anywhere from sort of 45% to 75%, depending. I think right now we're currently written just over 50%. We've brought back the right level a bit because we know that when you look at the oversold position of the long bonds,
Yeah.
and just look at any RSI chart, you'll see these are very oversold at this point. So we actually want to be positioned for if we see a rebound or reversion back to mean in that portfolio. But at the end of the day, we're probably on average about 65 to 67% written in that portfolio. Sometimes it rises, sometimes it falls, depending on what's happening in the market and the volatility levels. But back to that second question, we do, and we make sure that we've got the ability to continue to pay that distribution.
Yeah, you've answered all three questions here, and these are the most common ones in
And if
terms
we
of.
do a levered, we want to make sure the same thing. We want to make
Yeah.
sure that, if this thing gets hammered because rates jack up faster than people think, that that distribution is sustainable. That's very important to us and your
Okay.
clients.
Yeah, yeah, for sure. I mean, I'm surprised the right level is lower than I expected it to be, but and this is the benefit of active management too, right? If TLT, I always I think happy T, I think TLT. I mean, that's basically almost
Mhm.
what it is, right? With covered calls, but it really tracks TLT. So if TLT is taking a beating, obviously you want to write less because there's more of a chance that it'll go up. So this is another advantage of active management. I know you guys
Mhm.
are do that. It's not a rinse and repeat. Let's write at
Correct.
75, right? You're varying it depending on market conditions. So yeah, thanks for answering all these. You answered all three of them, basically. And you probably answered this already. Why do you think TLT, aka Happy T, has been going down lately? I've been getting a lot of concerns because people say this is supposed to be safe, long bonds, but long bonds have higher volatility and higher risk than medium and short bonds. So why do you think that is that there's this volatility recently with TLT?
Well, and like I said, you've got to understand that you're in the 17 to 20-year bond market. So when you get on the shorter end, you get the movement. It's like a sort of a plane. At the back of the plane, you're getting a lot more movement if you're going over turbulence, and if you're sitting at the nose of the plane. It's the same thing with the bond market. The shorter end part of the market is not going to capture as much volatility as the longer side. So you've had the overall, I'm looking at myself, I'm backwards here, but the overall market's been sort of starting to come down, but the long end is still higher. And therefore, that's pushed up um, the interest rates and pushed down the bond prices versus the shorter end of the market. Am I making sense to you? So
Yeah,
the
yeah,
short
no, that makes
market
sense. Yeah.
has dropped down. The longer end has not come down as much. As a matter of fact, it backed back up because of the strength in the U.S. economy and some of the inflationary ideas that the U.S. presidential candidates are talking about. So that's all sort of playing into the longer end bond market here. But
Yeah.
TLT, any really long end bond has had the same sort of experience. They've all sort of tracked together down or up, and that's what's happening here.
Okay. Yeah, that makes
And I know that doesn't make people feel any better, but that's the
yeah.
reality of
It's
having
just
a long term.
it's
When
fixed
you have a
income,
long term
right?
bond,
It's
yeah.
yeah.
And HPYM is the medium term. You can see if you track them both, the HPYT and HPYM. HPYM is much smoother. It doesn't have the high highs or the low lows because it's a shorter duration bond. And then our T bill is a short term cash, so it doesn't move at all. So we sort of have three different parts of the spectrum there in those fixed income funds.
Yeah. And would you say the longer term bonds, you're gonna expect the highest risk, right?
Well,
In
your
this
highest risk is
world.
always longer, yeah, always out in the curve. So the further out you go in the curve, like I said, it's not the underlying credit quality of the bond itself in the case of the US government, but it's the movement in those rates at the longer end. And quite frankly, when the rates do start coming down, they'll go down as well. And we'll see the curve sort of normalize and um, the performance pick up from the standpoint of NAV growth.
Yeah, yeah, for sure. But especially the shorter ones, you're getting less income, less income for investors, and
Right.
I've read that this is what typically prompts investors to start getting out and going back in equities or dividend stocks,
Hmm.
specifically. Okay, perfect. So let's go to the next set here. You guys launched a bunch, four to be precise, Amazon, Microsoft, Lilly, and Nvidia.
Right.
Single stock cover call ETFs, leveraged versions, non-leveraged versions, Canadian or all Canadian listed Canadian currency, and even .U USD currency. So
Mhm.
a few questions here, and again, I can't talk about future products, but if you're planning to launch more, especially MicroStrategy, that's actually one that's very interesting to me. It's
Mhm.
like a leveraged Bitcoin play. I actually invested in a US one. So yeah, all three of these questions are basically kind of the same.
Right.
Do you have plans for new ones? Some people are talking about Palantir, Tesla. What would you say to
Mhm.
these?
So the answer is yes, we are planning to launch more.
Great.
Do want to these first four are actually coming out. We're happy with the way they're going. As I mentioned, I think on our last call, that we launched four of each because we wanted to see when you talk to 100 people, you get 100 different answers. But when it comes down to investing, we found that most of the money was flowing towards the Canadian levered versions. So whatever Canadian dollar. So whatever
Okay.
we do going forward, we're going to do Canadian dollar and levered versions of that. So we are planning to launch another four. We could be sitting with possibly 20 of these a year from now. It's a category that we like. It's a category that we think we're seeing the changes going on in the US market. We want to bring some of those changes to Canada as well. And so I guess the short answer is yes, we do have more in the pipeline coming down the road, probably late this year or into early next year.
Fantastic. That's welcome
Like,
news. I own some of them myself. I started dabbling into these. They're low fee. I like the leverage ones. I'm happy to hear that going forward, they're going to be the leverage ones only. I think it makes perfect sense. And I think the .U ones, like you mentioned, not that popular, right? So some people really, really want it, but I think most people are not investing in the .U ones. Is that what you're seeing so far?
yeah, the majority is going to the Canadian levered versions, the higher yielding, more torquey, so to speak, than the US dollar, and especially the non-levered versions. But we have a lot of various clients, obviously direct investors as well as advisors. A lot of people own these stocks in US dollar terms. So we were getting, when we were sort of doing our initial surveys of the market, we did have people saying, well, I own it in US dollars. Will you bring these out in US dollar uh, products as well, ETFs? So this is the reason why we launched them all, but we're finding that still the majority of the flows go to Canadian dollars. So that's where we'll continue to focus going forward.
And I have to ask this, and you already know what's coming. What do you think of an all-in-one? If you're gonna have dozens of them, do you think
Mhm.
that might be something on the table for you guys to also launch an all-in-one?
I think it's a great idea, Adrian. I really like that idea. So I think I see that in the future as well.
That's fantastic. I think you're gonna make a lot of people happy seeing this video, Mike, including myself.
Okay.
I'm smiling ear to ear in case you don't see it. Okay, perfect. So let me just wait. Let's go to the next question. A couple of general questions. I have to admit, I get these all the time,
Mhm.
similarly worded. I'm very curious to know what an experienced professional fund manager like yourself says to this. And let's start with the first one here. Hopefully, you could see my screen again. It's about market
Mhm.
crashes, right? I'm sure you got many concerns about the upcoming market crash, which, of course, there's always going to be a new upcoming market crash. But the question is, seeing many of your newer cover call ETFs were launched post-pandemic, not tested during the market crash. What option strategies or other strategies in general do you have to safeguard the income flow for investors for future black swan events, like a COVID
Mhm.
or market crashes?
Okay. Well, let me go back to one of my comments I made earlier that we've always been income generating. We launched our banks and buildings fund right after the financial crisis. And, I was being told literally, you're crazy. Don't launch that type of product now. But we've, for 15 years, been paying that income, and that's through COVID, that's through big market pullbacks. And when I talk about testing, we know that sometimes once a year, sometimes once every 3 years, you get 10 to 20% pullbacks in markets for any number of reasons. every decade or so, you can get a 30 to 50% pullback in a market. We have to expect it's going to come at some point. And if we even think about COVID and what happened just a few years ago, I remember in 2019, we were looking at the market, we were looking at the economy, where interest rates were, and so on. We thought, boy, what could happen? And everything seems to be going along pretty well. And then COVID hit. So,
Yeah.
it took markets down, I don't know what it was, 35 or 40%, by March. So, and they did rebound. So you just always have to be sort of prepare for these things when you're developing these types of products. There have been a number of funds that we've launched since COVID, but I would say the majority of our assets definitely evolved and launched before COVID, and some going back as long as 15 years. And at this point, we've paid out over $1 billion in income. We're very proud of that number, and we'll make sure that we test and we can maintain our ability to pay those yields regardless of the market scenario.
Yeah, and the proof is in the pudding, and that's, like we discussed
Right.
before, you guys are you do the back testing, very reliable, and I'm so happy COVID happened
Mhm.
because I remember seeing my account in the red, minus 35%. It was actually, that's the number I remember, minus 35. But back then, a lot of the products I invest in now, mostly pure covered call ETFs, did not exist. I had still a lot of single stocks, single REITs, a lot of small cap
Mhm.
to mid cap stocks. And I'll never ever forget, it's literally one of the biggest investing lessons I've ever learned. All the damage, all the income damage, the distribution, either elimination, dividend elimination, dividend cuts, mostly all happen with the single stocks, single
Mhm.
REITs, covered call ETFs, untouched. It was incredible. So,
Mhm.
and I mean, a protection. The covered calls are actually a protection against downside. It's a byproduct of covered calls. It's not just income. For me, it's the top priority, obviously, but people invest in them also for that downside protection during market crashes.
Right. It certainly provides a buffer and provides that additional income, which makes when you go through these downturns much easier to get through that when you've got that cash flow coming in.
Awesome. Next question is a question I get once in a while,
Hmm.
typically from, I would say, newer investors. Maybe that's not the right way of saying it. Low volume. So the question is, some of your ETFs have very low volumes. Are you worried about that? It's a red flag for me. I get very scared when I see something like that. What do you think? How would you answer that question?
It's not an issue at all because the great thing about the ETFs is there's a complete sort of capital market structure behind all of the ETFs. And in the case of, say, Harvest, I can only talk about our own. We have every major bank in Canada as a market maker behind our ETFs. So we have six different market makers. Actually, we have some independents. I think it's eight market makers. And basically, they're providing what are called these sort of prescribed units or PNUs of 25,000 units on the bid and the offer all the time. So an ETF may only trade, say, 5,000 shares a day, but if somebody wants to buy or sell 100,000, there's a market maker on the other side that's willing to. Usually, there's a penny or two like difference between NAV, but there's always a buyer or seller on the other side of that trade. So different than stocks that will fall considerably if you have a lot of volume selling. Um, these will only fall to the NAV value versus, give or take 1 cent. They will always have that NAV value. If the overall market's falling, well, then they'll fall too, but
Of course,
with the
of
market, with
course.
their underlying portfolio. But we have many times sort of institutions and advisors that will call us up and they say, I want to buy or I want to sell 1 million or 2 million or 5 million of XYZ. We will build a position so that we can take that off their hands. We'll contact our market makers and say, someone at CIBC has an offer that's coming in or a bid coming in for, can you put together a block of shares? So there's always a healthy market on the other side. You just don't see them, but there are market makers there to help offset those what looks like low volumes.
Yeah,
I
and
think from the standpoint of being an ETF provider, it's probably one of the most frustrating things to deal with because we get the question, especially from some stockbrokers, advisors, like, well, this only trades by appointment. It's like, but it doesn't matter if you want to buy it, you can buy whatever you want because it's always going to be at NAV.
yeah, it is very frustrating, and
Yeah.
you gave the very nice technical explanation, but I
Yeah.
think the first sentence you said, no, it's not a problem. That's typically what I
Yeah.
always respond to, because it gets so frustrating that you don't realize the ETFs, they, like you said, that the whole thing with the NAV. And from my experience, I've never, ever, ever had an issue with ETFs with super low volumes, especially some that are new. It's normal for them to have lower volumes. Like you said, there's market makers out there. I think people think that it's a negative sign for the fund, or it
Mm-hmm.
impacts the fund, but it does has no impact on the NAV performance at all, right?
Correct.
There's market makers, and the only piece of advice I would tell people in practical terms, if it does have low volume, use limit prices when you're buying or selling. I think that would be my
Mm-hmm.
recommendation, just in case, because and then a market maker should swoop in and you'll get a couple of pennies up or a couple of pennies down. That's
Mm-hmm.
just my experience. I personally never ever had a problem, and I've invested, bought and sold many, many, many ETFs with very smaller ones because they're new or whatever with lower volumes. So
Right.
that's what I would say for that. But thanks for explaining that. I understand why it's frustrating.
Mm-hmm.
Last question, and I get this one again as well. I understand this is really personal choice. Recommended reinvest percentage for income seeking folks, right? So a lot of people are living off of this income. They're investing in these. They don't want to touch the capital. They just want to live off the dividends. They want to live off the rents, which is
Right.
the general premise behind my platform and my channel, is what I kind of preach and what I do.
Right.
I always say there is no recommended. It depends. It depends. It depends on your situation, et cetera, et cetera.
Mm.
What would you say to that? Anything to add besides it depends?
Well, I think if you're buying products like ours, or you're buying products for income, then you should just take all the cash flow, take it all. But if you're not really, if you want to get more growth, then maybe you go with more of an index product, or more of a product that doesn't pay, or isn't part of the agenda, or I should say the objective to pay that income. Um, I would think if you're retired, or you're planning to retire, or you're trying to supplement your income, you're going to figure out how much income you want first, and then what products do I buy, and how am I going to allocate it? How am I going to get that cash flow? So if you're buying income products, and you don't need the income, then I would just say, well, file it all back into the fund, do a drip. But if you're buying for income, take the cash flow out. And as you
Yeah,
were
of
saying, everybody's situation is different.
course.
Um, their age, their financial situation, their assets, etc., how much cash flow they need. Are they helping a child? Like, there's all kinds of reasons why people take income. So it's hard to sort of have a pat answer, but I would say if you're designing your portfolio to generate cash flow, take the cash flow.
Yeah, yeah.
Maybe that's too simple an answer, but
No,
that's the
it makes sense. I like what you said exactly. These are designed for income, not for growth. But if you just turn the drip on, you literally turned that. That's the way I see it. You literally turn your income investment into a growth investment, where
you
you're
get
just
your
growing.
compounding, right?
Yeah, you're growing with compounding and capital appreciation, but most of that growth is going to come with more units. Whereas an index fund, you're growing mostly with your capital going up. This is why I personally, let's say, as a hypothetical, I don't need the income. I would
Hmm.
still personally always go with the income products because I love them so much. I'm less dependent on what the market does, right? If the markets, you eliminate your drawdown problem,
Hmm.
and you could just turn off the drip when you need the income. You don't need the income, you turn on the drip. And if markets go down 20%, well, now you're compounding at, you're buying cheaper shares. So it actually helps you, right? So
Right.
I just find it eliminates so many problems, but I appreciate your answer there. So
Or
Mike, that's,
you
yeah,
can let the
sorry.
cash build up, and then when you do get these market drops and swoons in the market, you've got a little pile of cash there to invest, right?
Yeah, you
So
could do that
that's
too.
another,
You
yeah,
could do that too. I consider that
yeah,
more like market timing, but
yeah,
this is where it's personal, right? You have to
right.
develop your own. So these types of questions I get all the time. What is the best? What is the recommended? And this is why it's so hard to find answers online, because the real answers, it really depends on your situation and your goals and your objectives. So the most important thing
Absolutely.
is understand the products. That's what I always say.
Yeah, absolutely.
Okay, well, listen, it's been great. I could talk to you all day, and thanks for answering member questions. I really appreciate it. If you want to ask questions for the next time, got to be a member,
Mhm.
just hit that join button. So, Mike, we've had a great 2024, been on the channel several times. Looking forward to
Mhm.
2025. We'll see what the election
Yes.
brings. I'm crossing my fingers for a market crash, but you know why.
Yeah.
I want to buy cheaper units.
Yeah.
That's it.
Yeah.
And I don't need to sell anything. I'm not going to sell anything, so I might as
Right.
well. I want to buy units cheaper, right? So, anything
Of
you want to
course.
close off with to the audience? Go ahead.
Just as I've said many times, we're about long-term capital growth and generating cash flow. Um, the majority of our portfolio, even though there's been a lot of attention around the fixed income lately, HPYT particularly, the preponderance of our assets are in long-term equities, companies that we own and that we've had in some cases many times. Some of these companies we've turned into the single stock as well, like Lilly, which we've had in our HL since 10 years since we launched the fund. So again, that just goes back to that long-term approach and that long-term steady cash flow that we want to be known for. So we have some high-paying products. We have some not so high-paying products, but the idea is we want to be consistent and take care of our unit holders over the long term.
I agree with that statement. I mean, that's what you guys been doing. Like you said, if you look at distribution rates, they've only ever stayed the same or go up. They're very, very reliable and consistent. So, Michael, thanks so much for doing this. Hope to talk to you again soon. Looking forward to those new products, of course. I'm always going to be on the lookout. I really like those single stock leverage ones. I'm excited if you guys come out with an all-in-one. I think that's fantastic. So we'll keep an eye on it. So, Mike, again, thank you so much and take care.
And thank you.